I mean, this is all deepening the liquidity of the market, which is what that's a lot of what they're studying right now. How liquid is this market? Do we need derivatives? We'll wait for derivatives. I mean, they will use, I think when one goes though, the others will follow quickly. So I don't know if they'll wait another 6 to 9 months for derivatives. Maybe. I think someone will jump the gun before that, especially because it's become such a big campaign.
Hey guys, welcome back to Everyday Finance. In this video, Cathie Wood discusses Bitcoin and crypto. In 2015, Ark Invest first entered the world of Bitcoin. However, it was in this year that they were able to truly make a move by acquiring shares of Grayscale Bitcoin Trust, GBTC, a security that they could include in their ETFs. ARC's founder, Cathie Wood, sought validation for the economic argument from renowned economist Art Laffer, after Chris Barisi wrote a white paper exploring whether Bitcoin could serve the three traditional roles of money and delved into the underlying technology. Laffer reviewed the paper and appraised it, endorsing it at that time. In 2024, Bitcoin's network value or market cap was a mere $6 billion. Cathie Wood pondered the potential size of Bitcoin, prompting laughter as someone suggested comparing it to the US monetary base, which stood at around $4.5 trillion. This comparison fueled Ark's confidence in Bitcoin's growth potential. Consequently, Ark purchased GBTC, initially facing restrictions that allowed them to hold only up to 1%. However, they managed to right the appreciation and increase its share to 10% of the portfolio at one point. Fast forward to 2024. Cathie Wood and Art Laffer participate in an interview with Preston Pysh at the Bitcoin Conference 2024, where they delve into Ark's humble origins and showcase their extensive knowledge of current global monetary policy. And lots of things Cathie Wood discusses, so please watch the video to end. And share this video and subscribe our channel Everyday Finance. Thanks.
You know, that was a moment. Remember, he was denigrating Bitcoin for years, very focused on the environmental side of it. But how is it perceived? Well, the first thing that happened was Grayscale, because it kept its fee at 2%, donated a lot of share to all of us. Right? I mean,
why was that? That just doesn't make any sense.
Well,
why they kept
put
it like
this way. We think it was a miscalculation, and the CEO, who I've known him for a very long time, he quit. I think, and now they're putting. If you look at what they did with Ether, they have they've introduced not only the conversion into the Grayscale Trust into an Ethereum ETF, but also an Ether Mini for 10% of it. So the cost there is 15 basis points. And I think I don't know if they're keeping it at the rest at 2%. I don't know. I don't understand the strategy. But first donated a lot of share, grew the market in terms of, beyond what Grayscale offered. So the education of 11 ETF providers vying for business at the same time, the education around that was tremendous. And you had most of the major asset management institutions involved, whereas, when we were in our early days, they thought we were using a marketing gimmick, or there was, always a reason not to consider what we believed was a new asset class. So first, donation of share to lots of other players, all of whom have educated. But the most interesting thing is it really has not hit yet, because the big platform, we call them wirehouses. So Morgan Stanley, Wells Fargo, Bank of America, Merrill Lynch, LPL would be an independent one, UBS. None has approved them for the platform. And everybody.
Is that the 6-month mark I keep hearing that they needed some?
I don't know what, yes, that we were told by the most progressive of all of them, we need 3 to 6 months. Okay, so now we're 6 months in. And I'm sure at one point, price hit 70. They thought, oh, we can't put, this is very volatile. We can't put our clients in this. We'll wait for a correction. The correction was much more shallow than they expected. There was one immediately after launch. But no one jumped on the recent one, which is interesting. So I think they're still trying to get their arms around it. They probably have to hire analysts to support them, because otherwise it's on the management team's backs. This is their risk. So I think they'll have to get a little bit of an infrastructure going. And we're starting to see that. We're also starting to see some demand pull from clients, which is good. That will get top management to make the investments in the research team to make this happen. So it's a slow process, but, despite what seems to be a wonderful success, it hasn't even begun.
Bitcoin experienced an 8% decline from September 4th to September 6th, dropping below the $54,000 support level for the first time in over a month. The correction gained momentum after the release of U.S. labor market data, although negative momentum had already been building due to ongoing outflows from spot Bitcoin exchange-traded funds, ETFs. Traders are now exploring the possibility of other factors that may have contributed to this recent price weakness. What is the probability of Bitcoin returning to levels below 50,000? It is crucial to evaluate the impact of weaker than expected U.S. non-farm payroll data on the Federal Reserve's strategy of lowering interest rates without triggering a recession. According to Vargas, a global macro strategist at Carson Group, the payroll data suggests that there are increasing risks as the labor market is showing signs of weakening. Vargas believes that it is necessary for the Fed to intervene and mitigate these potential risks. Despite this, there is ongoing debate about whether the September 6th labor data will lead to a larger stock market correction. However, according to the CME FedWatch tool, the likelihood of a 0.5% rate cut in September has increased. The S&P 500 is currently poised for a 4% weekly decline, which could potentially make it the worst 5-day performance of 2024. This downward trend is primarily attributed to losses in the tech sector. Emily Rowland, co-chief investment strategist at John Hancock Investment Management, discussed the market's fluctuation between perceiving bad news as either bad news or as potentially good news. There is a sense that this could reignite hopes that the Federal Reserve will take more aggressive actions than what the markets currently expect. In short, traders are expressing concerns about recession risks while also remaining optimistic about the possibility of a shift towards a less restrictive monetary policy. Zach Pandel, the head of research at Grayscale Investments, expressed a positive outlook. He pointed out that the August jobs report was favorable for Bitcoin, as the overall market has experienced a slowdown. This slowdown creates an opportunity for the Federal Reserve to lower interest rates. However, there are currently no indications of an impending recession. Pandel also noted the potential impact of the upcoming U.S. presidential elections in November and the significant budget deficits on the institutional adoption of Bitcoin. This is particularly relevant given the current uncertainty in traditional markets, especially in the tech sector and artificial intelligence investments. It's evident why investors have hesitated to expand their Bitcoin holdings despite the recent decline in price. In addition, the conglomerate Berkshire Hathaway, led by Warren Buffett, has further decreased its stake in Bank of America. This move has only contributed to the prevailing bearish sentiment, which is evident from the recent 7-day record of net outflows from US-listed spot. Traders are currently questioning the impact of the Bitcoin ETF and speculating on whether the recent price action is influenced by savvy investors who are anticipating more volatility. This anticipation has raised concerns about potential turmoil in risk markets. Some argue that concerns about a potential tech bubble are fueling the interest in short-term government bonds. While others highlight stress in the commercial real estate sector, Let's get back to Cathie Wood interview.
Yeah, I mean, this is all deepening the liquidity of the market, which is that's a lot of what they're studying right now. How liquid is this market? Do we need derivatives? We'll wait for I mean, they will use, I think when one goes though, the others will follow quickly. So I don't know if they'll wait another 6 to 9 months for derivatives. Maybe. I think someone will jump the gun before that, especially because it's become such a big campaign issue. And you've got, I mean, former President Trump, taking donations in crypto. Wow, that was surprising. But saying that he would guarantee the right to self-custody, very big in this community, right? Very, very, very big. Focusing on the miners and saying, yeah, America first. Yeah, we need them here. That's great. That was wonderful. And then, of course, what happened in Congress, the idea that the FIT 21, so Financial Innovation Technology of the 21st Century Act, FIT 21, got 76 or 78 Democratic votes in the House. Nobody expected that on Wall Street. Maybe that was becoming current wisdom, but that was big. That was big, I think, in terms of what I just said. The financial markets are waiting for cues to say, okay, it's okay to go. It's okay to go. I think, once I think financial institutions become comfortable with the liquidity, and they're going to start, and our industry has scaled because of, companies saying, okay, we can structure a portfolio in this way, and here's the return risk profile of this portfolio. And, advisors in particular know what the risk return profile, when they get that kind of information, like providing I know you've done great. You should be presenting this on how much more productive Bitcoin 2%, Treasury bond 98% would be relative to just bonds over time. And I think that will continue, and they will be onto it. But, and it's important too, because advisors are always thinking about risk, especially given the last 25 years, tech and telecom bust, 08, 09 meltdown, COVID, and so forth. So they're always thinking more about risk than return. And you're presenting them with a very interesting dynamic, which is, as we said, the 2 and 98%. This once we get some of these platforms to approve it, we're going to see all kinds of products like that.
Regardless of the factors driving traders to be more cautious, the yield on U.S. Treasury 2-year notes has reached its lowest point in 2 years. Investors are now willing to accept lower returns in order to prioritize the security offered by these bonds. In addition to the bearish sentiment, there has been a recent unfavorable ruling regarding Coinbase's attempt to dismiss a class action lawsuit filed by its shareholders. According to the plaintiffs, the exchange failed to inform investors about the potential risks of regulatory action and asset losses. While the ruling may not have a direct impact on the price of Bitcoin, it does decrease the motivation for institutional investors to participate in the market. Bitcoin investors are also worried about the possibility of miners having to sell some of their holdings. According to Glassdoor data, miners have been accumulating Bitcoin since August 15th. However, with the price still below $60,000, there could be selling pressure from miners. Both macroeconomic factors and regulatory concerns, along with the fear of a miner sell-off, are contributing to the overall bearish sentiment surrounding Bitcoin. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.